Good afternoon, ladies and gentlemen, and welcome to the broadcast 2 and 3 for LFPP, which is retirement planning. You'll notice that you've got two quizzes on this topic purely because it's such a broad topic and because it makes up such a big part of your day-to-day advice that you give. My intention today is definitely not to be able to teach you all retirement planning. Of course, that would take much longer than a half an hour broadcast, but it is again to guide you with the quizzes, and then for all we know there might be one or two little exam tips that slip in as well. If we look at the introduction just quickly, again, as with all my other broadcasts, or the majority of them, I'm going to refer you back to Marius Botha's DVDs. It's incredibly important, ladies and gentlemen, that you make sure that you go and understand that I'm not going to go through the information that he already does with you in those DVDs. So as far as income tax goes, as far as lump sum taxation goes, and as far as the capital needed and capital available calculations go, that you can all familiarize yourself with through making use of Marius Botha's DVDs. They give you an incredibly good explanation of all three of those topics. So not just for the purposes of today's broadcast, but also for the purposes of the quiz, you need to be able to do especially lump sum taxation calculations, as well as capital needed and capital available calculations. So please make sure that you go and do that on your own and that you are familiar with time value of money calculations and, as I say, with the tax. What I'm going to be looking at today very briefly is the differentiation between the various types of funds that you have, the payments of contributions made by the employer on behalf of the employee, commutation and transfer of funds, and then we're going to look at estate duty and income tax, and the minor changes that we've had in that. We're also going to look at divorce, and then I'm going to look at Section 37 as a whole. That's one of the most important things that you as an advisor deal with on a day-to-day basis, and then very briefly at the jurisdiction of the pension funds adjudicator. Okay, so ladies and gentlemen, let's firstly look at what a pension fund is, and I'm literally just going to go through that. I can advise you to maybe have your textbooks on hand. You'll see on most of the slides that I've made available to you today, there is a little block somewhere on the slide, and it refers you to the actual pages in the textbook as well, or the handbook, whatever you want to call it. So please make sure that you have your handbook ready with you. You can pause this at any time. As you know, go read through the portions in the handbook that are relevant and then come back if need be. So please have your handbook with you. So if we just quickly go through this, you'll see a pension fund, and this is just a summary. Fund must be registered with the Registrar of Pension Funds, and again in the handbook you can see exactly what the process is. There always has to be an employer-employee relationship. So this is one of the things that are not deemed to change with the pending changes that we're waiting for, either come 2017 or 2018. So there's always going to retain, or the employer-employee relationship will be retained as far as pension funds are concerned. A fund must be a permanent fund, bona fide, established mainly for the purpose of providing annuities to members and dependents of members. There can't be other. It can't be a profit-making organization. It can't be to dabble in shares. It must be a bona fide fund registered in order to make sure that a member at retirement or his or her dependents or beneficiaries at that stage receive an annuity during retirement or at death for the dependents. Membership is compulsory for all employees who meet the criteria of the class for whom the fund was created. Now, this is what distinguishes a pension fund and a provident fund from an RA and an umbrella fund. For a pension fund or a provident fund, the fund is created for the purposes of a specific class of people. So, as at the University of the Free State, we have a provident fund and a pension fund, and depending on the manner in which you are employed, you are either classified as an employee for pension fund purposes or an employee for provident fund purposes, or if you have a certain classification, you could fall into the category for either, where you have a choice as an employee to either belong to the pension or to the provident fund. Contributions, it's monthly paid by the employer on behalf of the employee. Now remember, you as an employee generally don't make contributions to a pension fund. The employer will, on your behalf, take a certain amount of your cost to company as your salary and contribute it to the pension fund. And they then, on their behalf, also make a contribution to the pension fund. You are currently only allowed 1/3 lump sum in cash. except where the total benefit is not more than 247,500, then the total benefit can be taken. The 2/3 is then to buy a compulsory annuity, or of course, if you decide to take the full amount and transfer it to annuity, then the entire amount will be seen as a compulsory annuity. So you won't have a distinction then between which portion is a voluntary annuity and which portion is a compulsory annuity. You'll then see the entire amount as a compulsory annuity, and that of course is because there will be tax implications, whether it's a compulsory annuity or a voluntary annuity. Termination of employment is deemed to be resignation from the fund, so it either resigns, dismissed, retrenched, or winding up, and this can be taken at resignation, I beg your pardon. And of course, you are not limited to your 1/3 resignation. You can take the full amount and transfer it into another fund. And a contribution deduction is 27.5% of income or remuneration, whichever is the greater, limited to 350,000 Rand for a year. And if you have any amount above that amount, you can of course carry it over to the next year. We'll speak about that a bit later. And contributions made by employer are now deemed to be a fringe benefit in the hands of the employee. If we then look at a provident fund, very, very similar to a pension fund, the only difference here is that upon resignation or retirement, you are entitled to take the full 3/3, and then of course the tax tables for resignation or withdrawal will be applicable. So just quickly, fund must be registered with the registrar. I beg your pardon. Employer-employee relationship is also a requirement, and again, this is not something that is in the cards to change from 2017 or 2018. The fund must be a permanent bona fide fund established mainly for the purposes of providing annuities to members and dependents of members. So it's not necessarily the same effect as annuity in the sense of the word as a pension fund, but at least to give a benefit to a person at resignation or retirement. Membership is compulsory for all employees who meet the criteria of the class for whom the fund was created, exactly the same as a pension fund. Again, the termination of employment is deemed to be a resignation from the fund. And then here's where the difference comes in. And with a provident fund, you are entitled to make a full 3/3 withdrawal at resignation and at retirement. Okay, and this differs then from a pension fund where you're only allowed to take 1/3 at retirement. There's no compulsory annuity. However, if you do decide to take the full 3/3 and transfer it to an annuity, it can also be seen as a compulsory annuity. Take the lump sum and then purchase an annuity, there's a capital element that will then be subtracted for or exempt for income tax purposes, and that is in terms of a voluntary annuity. And then again, the contribution from this year onwards already is the 27.5% of your taxable income or remuneration, which is ever is the greatest, to a maximum of 350,000. And then any amount that is above that, you can of course roll over to the following year. And then contributions made by the employer are deemed to be a fringe benefit in the hands of the employee. So any person who's a member of a provident fund from this year onwards would see a slightly increased amount in their monthly remuneration, purely because you're now entitled to a tax deduction for the contributions. Okay, if we then look at a retirement annuity fund, it's designed for individuals, so there's no employer-employee relationship, and this is not deemed to change in future. An employer may contribute to an RA. I think we're often under the impression that, oh, okay, because it's not an employer-employee relationship, the employer may not. What happens in a lot of the smaller companies, they'll say, you know what, we're not going to manage a pension fund or a provident fund on behalf of our employees because we're a small company. But should one of our employees decide to take out an RA, we will, on behalf of the company, contribute 1,000 Rand a month. That 1,000 Rand is then deemed to be a fringe benefit in the hands of the employee and can also, of course, be deducted in the hands of the employer. Lump sum or contributions or any amount made by the member or on behalf of the member. So you can, with a pension fund and a provident fund, you make your monthly contributions, and there can be lump sum contributions if it's in agreement with the employer. But with a retirement annuity, you can decide how to contribute to the retirement annuity. You can contribute a lump sum now plus monthly amounts. You can do ad hoc monthly contributions. You can do ad hoc lump sum contributions. This is really a tailor-made solution for someone, especially someone with their own business. We all know some months are great, some seasons are great, some seasons are not so good, and some months are not so good. So if you're having a tough month at work this month, and you don't see your way out to contribute 1,000 or 2,000 Rand to the RA, then you can simply not make the contribution for that month. So it's a very flexible option, especially for self-employed persons. And then the cap age of 70 was removed, so you are now allowed to stay in a retirement annuity for as long as you want. So you don't have to take your cash or your amount from or by the age of 70. Okay, retirement annuity or an annuity and a 1/3 lump sum unless the total value is less than 247,500. So the same 1/3 limitation that you have in a pension fund, you have the same 1/3 limitation in a retirement annuity. So you're not entitled to take more than the 1/3 in cash. You have to purchase a compulsory annuity with at least 2/3 of the value at date of resignation or retirement or withdrawal, and that can only happen after the age of 55, unless, of course, your entire fund value is less than 247,500. Preservation fund, as I say in the third bullet there, it is really just a parking bay for funds. So we all know with the Y generation and the employment psychology that's being applied now, that most people say you shouldn't stay with any employment for more than 5 years. You should move from one employment to another as regularly and as often as you can. And for that specific reason, because people are not starting with a company at the age of 22 and staying there until the day of retirement, this has become such a necessity for us to be able to say, you know what, there is a way in which you can preserve your funds. So we've got what we've called preservation fund. So you either have a pension preservation fund or a provident preservation fund. We'll look at the transfers in a little bit. But basically what it says is if you move from one employer to another employer, as opposed to taking that money and thinking you're going to pay off all your debt and you end up having a nice overseas holiday and you have to start with retirement planning from scratch again because you've moved from one employer to another employer, they say we'll give you an easy option. Most of the transfers are tax-free. So if you transfer from a pension to a pension preservation fund or from a provident fund to a provident preservation fund, there's no tax implication. So you can do that transfer tax-free. And it really is just a case of where you can park your money. It normally earns more or less the same growth rate, and you can have your fund parked there until you either move to another employer who has a similar fund, or until you withdraw your funds at a later stage. And just as I mentioned, you can't contribute to that fund. So it is literally a parking bay. You cannot go and say, okay, well, I'm parking my money in this fund. I want to contribute 2,000 Rand a month into it. There are no recurring contributions that can be made to a preservation fund. And then just an umbrella fund. An umbrella fund is really just a fund where we say, okay, I'm a really small company. I can't afford or manage from a human resource point of view a fund exclusively for my 10 or 15 or 120 employees. So I rather want to pool together with another 2 or 3 employees and say the 3 or 4 of us can start a pension fund or a provident fund that is then managed by an independent party, and that is then what we call an umbrella fund. So we basically pool together all our resources. So not just our employers or our employees all under one umbrella. We also have the management of a third party. So you take the entire human resource element out of it, as well as the risk of the management for a small company out of it as well. So as you can see in the bottom corner, there is some reference to the study or the exam, not the exam, the handbook, the textbook, and from page 885 to 902, you can go through all the detail regarding the different funds that are available in retirement planning. Okay, so the payment of contributions, as I've mentioned, for a pension fund and a provident fund, which are your employer funds, there's always an employee-employee relationship that defines your membership towards the fund, and the employer is thus liable to pay the contributions to the fund on behalf of the employee. Such funds must be paid within 7 days of the end of the period to which the contribution relates. So in other words, normally in most instances, I know there's some instances that work differently, but in most circumstances it is that contributions are paid to a retirement fund, whether it be pension or provident, on a monthly basis. So if I know that my contributions for August need to be paid by the 7th of September, so before that date, for September by the 7th of October, so it's always paid within 7 days of the end of the period to which the contribution relates. If it's biannually, it will be the 7th of January for the December ending period ending December, or the 7th of July for the period ending, let's say, end of June. So whatever the period is, plus 7 days, and within those 7 days, the contribution must be made. If the payments are more than 90 days late, then the Board of Trustees must report this within 14 days, and penalties will be implemented to make up for any possible loss in growth. So there is no alternative to this. You need to pay within 7 days, and if there's any late payment, then the obligation lies on the trustees to report the late payments as soon as possible. Okay, commutation of funds. I must say, to this day, I still get confused when people speak about the commutation of funds and the transfer of funds. So just to make it very easy and in very broad terms, I put a definition in there. So commutation of funds means to take an amount out of the fund in cash, where a transfer means you're transferring between various funds. So it's not a transfer from a fund into your bank account. It's a transfer between various funds. But if you do have a transfer from the fund into your bank account, then that's deemed to be a commutation, because you're taking it out of the regulated structure that's registered with a pension fund. Okay, so a pension fund and an RA, as I said, you're only entitled to take 1/3. For a provident, you're allowed to take the 3/3 unless the amount is less than 247,500 Rand. Then you will be entitled to take the full amount, and that's for the pension and the RA. We all know about the changes that are pending for either 2017 or 2018. I've just been reading through a new spin on the budget speech and how some people have interpreted some of the amendments that eventually ended up being in the Act. And some people are saying that there's still going to be changes in 2017 and in 2018. So I think keep your eye on it. Make sure that when you advise your clients, you tell them, this is the advice I'm giving you now. These are the changes that are possibly coming in. If and when the changes come in, we'll have to sit down and restructure your plan a little bit. So just always keep it in the back of your mind. And then cash is taxed as a withdrawal at resignation and at retirement, and the tables vary depending on retirement or resignation. As I mentioned at the beginning of the broadcast, Marius Botha does an excellent example of taxation of lump sums. So you can literally go through the different methods, whether it be a severance benefit, a withdrawal benefit, or a retirement benefit, and how the various tax tables apply to those different benefits. Please make sure you go through the recording of Marius. Transfers of funds. Again, this means to transfer an amount to another approved fund. Again, the same concept, or the balance of the others. With a provident fund, you're under no obligation to transfer any portion. With a pension or an RA, you're under an obligation to transfer at least 2/3 to an approved fund, unless again if the amount is less than 200 or 247,500 or less, then you are entitled to take the full amount irrespective of the fund that you were in. Again, please make your clients aware of the fund changes that are pending for 2017 and or 2018. And traditionally an RA had lock-in provisions, but this is no longer allowed. So once you were in the fund, you weren't allowed to transfer or get out of the fund. So just be aware of the fact that no fund rules for an RA are allowed to lock you into the RA. If you want to transfer, whether it be via Section 14 transfer, you are entitled, you've got freedom to be able to put your funds where you want them. Most transfers between funds are tax deductible. This is to avoid an unfair tax implication where members must transfer due to, for example, a change of employment, or if there's a value structure that changes at a certain company and you no longer want to be associated with them, whatever the case may be. So in the next couple of slides, we'll look at the different transfers that are tax deductible. Understand a withdrawal, retirement, and severance benefits. Know the difference between the three. It's very important. And when you start watching Marius's DVD as well, you'll become very enlightened to why it is so important to really understand when is it a withdrawal benefit, when is it a retirement benefit, and when is it a severance benefit. Retire is normally retire, retrench, or die. So those are the things that are slightly less voluntary. We don't choose to be retrenched or choose to die or choose to retire. These are things that either due to operational requirements or retirement age or death, there are various other elements for that. So that these are the involuntary type of things, then it will be seen as retirement. But if it is a more voluntary side, such as resignation, then it is deemed to be a resignation benefit. Then if we just look at the transfer of funds, if we look at, and this is in terms of paragraph 6 of the second schedule, any amount that's transferred from a pension to a pension or a pension preservation or an RA are deemed to be deductible for tax purposes. So let's say I've got 100,000 Rand in my fund and I change employment. I move from one employer to another employer. I transfer my amount from my pension fund to my RA, then it's deductible for tax purposes. So there'll be no tax implication as far as that's concerned. Pension preservation, the same, to a pension preservation fund, or an RA. From a provident, now you can transfer from a provident to a pension or a pension preservation. You can't go from a pension fund to a provident fund. And why? Because of the amount you're allowed to take at retirement. Government's trying more and more to say, we need to keep people in the funds, because what happens now? I'm entitled to my 3/3, so I take my 3/3, I go pay all my debt off, I have a lovely year of great income on my, or not great income, just eating up my capital for the time that I've used my provident fund, and oops, a year later I realize I've got no money left, and what now? Now I become dependent on the state again. So the government's trying as far as possible to curb taking full amounts at resignation or at retirement, for that matter. So from a provident, you can go into a pension where you then locked into your 2/3, or to a pension preservation or a provident preservation fund or an RA. From a provident preservation, you can go into a provident preservation, a provident fund, or a pension preservation, or then of course an RA. And then from RA, you can only transfer into an RA. Why? Because there's no employer-employee relationship needed there. Whereas in many of the others, you will need an employer-employee relationship. This is the same at divorce. So if a divorce order says that the non-member spouse is entitled to X amount, and she then decides, or he decides, to transfer it from, let's say, a pension fund to an RA, then it will be a deductible transfer for them. And then transfers from pension to provident, this seems to be in abeyance until the 1st of March 2018. So we're still waiting for clarity on that, but that seems to be what the situation is going to be at the end of the day. I'm not going to hold my breath. I think they still have a lot of work to do between now and then. So we will, of course, keep you up to date if anything happens during the year. But for your purposes, for exam and quiz purposes, you work as what the legislation stands currently, and that is that the transfers as set out on this slide are the transfers, and any transfers between provident funds to, or pension funds to provident funds, will only become deductible from 1 March 2018. If we look at the further changes that took place, or the changes that actually came into operation then from 1 March 2016, the first one is the income tax. So we know that the contributions to the funds are tax deductible to a maximum, and that you also pay income tax on the income from the annuities and investments, but at a lower rate with higher thresholds. So basically what I'm trying to say with these two bullets is that with the income tax, what's happened now is any contribution made by the employer on behalf of the employees deemed to be a fringe benefit in the hands of the employee. So in your gross income, where you have a fringe benefit, for those of you who are not doing LFPE this year, I would suggest you go and look at the LFPE broadcast as well as the tax updates, because in your gross income now, you've got another fringe benefit. So you'll have your fringe benefit for the medical aid, and just under that, you'll say fringe benefit for retirement funds, and all contributions made by the employer are then deemed to be a fringe benefit in the hands of the employee. So that goes in under your gross income. Then under your deductions, and there's still a little bit of a grey area at this point in time, and you'll notice that in the quizzes going backwards, we haven't really asked a question that's affected by this, because we're waiting for clarity in this regard. We're getting one answer from some experts in the industry, and we're getting another answer from SARS themselves. We're getting another answer from Psycho, for instance. So at this point in time, there seems to be 3 different answers to where exactly in the sequence of the deductions the deduction for the pension fund, RA, and provident funds now go and lie. For those of you who can remember, if you looked at the old calculation, you'd have your pension fund, and then there were certain additions that had to be made before you made your RA calculation, and then you would carry on with your sequence. And there's not 100% clarity at this point in time whether we're following the same procedure as the RA calculation or the same procedure as the allowances, that you would have your taxable income taking allowances and capital gains into consideration. And do we take donations tax into consideration, or do we do it on taxable income as at after donations tax? I'm not going to say what our stance is at this point in time, because if we are wrong, then we have to redo the entire broadcast, but we will keep you updated as to exactly what the sequence of the deductions are. We've been very careful at this point in time not to bring any grey areas in, and we will obviously continue doing that if we don't have an answer by the exam time. But just keep an eye on it and make sure that you are aware of the fact that it's something that, in our opinion, is still a grey area. But just to recap again, so you have under your gross income a fringe benefit for retirements. So any contribution made by the employer on behalf of the employee is deemed to be a contribution in the hands of the employee, I beg your pardon. And then under your deductions, you aggregate all your deductions and you take 27.5% of your remuneration or your taxable income. Now, remuneration at this point in time is deemed to be all remuneration that you receive, excluding the fringe benefit to the retirement annuity. So you don't or the pension or the provident fund. So you don't take the fringe benefit relevant to the deduction into consideration. Take 27.5% of that, and then it's either that of the greater of your remuneration or taxable income. And then, of course, as in the past, it is, of course, also limited to the actual contributions that you make. So if you only had 20,000 rands contributions in the year, but your 27.5% works out to 25,000, you're only limited to the 20,000. But let's say your 27.5% worked out to 380,000, and there is a rollover that you are then entitled to. That would then be carried forward to the next year, but provided that you always apply the cap of 350,000 rand per annum. Now, a lot of people are saying, yeah, but there's unfairness now because I'm getting this deduction for tax, but they're going to get me the day I retire. What I'm trying to say here is that, yes, you pay tax on the income from your annuities that you're going to get at retirement, but by the time you don't have a choice at this point in time, with all due respect, unless you have your own business, to how exactly you structure your tax. So the tax rate that you get is a tax rate that you get based on your commission that's paid out to you and or the salary that you get. But when you are older, you don't need to always take all the funds at the moment you retire. The 70 cap on a retirement annuity has been taken away. So what you can always do is you can play around with your income in such a way, let's say, or with your clients, let's say you've got income from a retirement annuity, maybe some dividends or some interest. You can play around with a combination of the income to make sure that you live just on the threshold for tax purposes. So although, yes, you are getting all these deductions now, but they're going to get you on your annuity one day. You have the power of your income at retirement in your own hands. So you can make sure that the taxation that you pay on the income you receive, the annuity that you receive, you can keep that as low as possible by structuring your income at retirement in such a good way that you use your interest exemption, your dividend exemption, so that you make sure that you pay the minimum amount of tax. So it really is that balancing game now to say, okay, I can contribute as much as I can, get the maximum deduction, but then also make sure that my drawdowns at retirement keep me under the thresholds. Okay, then with the state duty, I've been doing a bit of marking over the last couple of days, and I've been finding a lot of people in the industry as well are still including retirement funds, provident funds, and pension funds into their state duty calculation. Remember, ladies and gentlemen, I think it's about 4 years now that all retirement funds are exempt from estate duty. So not even do you put it in under your assets or your deemed assets. You ignore it completely for estate duty purposes. The only portion, and this is a brand new section 332, that's now been incorporated into the Estate Duty Act is where you have a portion that was not deductible for income and was deducted against your lump sum when you did lump sum taxation. Then you are taxed on that amount as property in your estate. Let me give you an example and tell you why SARS has done this. What happened when the taxation rules changed with regard to lump sum and with regards to retirement funds? What a lot of people did is they said, okay, well, my retirement annuity is exempt from estate duty. It's also exempt from income tax, the capital element. And I'm also going to be able to get a deduction for it up to a certain amount when I actually make the contribution. Let me take out big portions of capital, whether it was from, I even know some people who sold farms and followed this, this method, whether it's from dividends that they were going to take or shares that they were going to sell, whatever the case may be, and they went and took huge lump sums, millions, hundreds and thousands, and they went and dumped it into an RA. So what happens now? You get a nice lovely deduction if you are entitled to it in terms of your income tax calculation. Then you park it into the retirement annuity. When you take the money out, or whether it be at death or not at death, there's no lump sum tax on that because it didn't rank for a Section 11K or N deduction. You can now subtract it against your income tax calculation that you do in terms of the lump sum taxation. That's if you're alive. But if you had to die and it was still in the retirement annuity, we know that retirement annuities are exempt from estate duty. So not only did I have the deduction if I had been alive in terms of the Section 11K and 11N calculations, I also at death didn't pay any estate duty because the entire RA is exempt from estate duty. And SARS came in and said, no way, you can't go park all your assets in an RA and not be taxed on it somehow. So that portion that didn't rank for a Section 11K or 11N and is still in the annuity at the date of death, so in other words, we haven't now gone and applied the deduction in terms of the Schedule 2 lump sum taxation. It still lies in the retirement annuity. SARS has come and said, on that portion that you've paid absolutely no tax, on that portion, we're going to expect you to pay estate duty. So if you weigh up now again, estate duty being 20%, and you also have your 3.5 million rebate versus the 36% that you can pay on the lump sum taxation, that's a nice gamble to take and leave the money in the RA because your tax rate is substantially lower by keeping it in the estate for estate duty purposes. So those are the two changes that did come into effect on 1 March 2016. With regards to the income tax, it is from 1 March 2016 and also all contributions from March 2016, whereas with the estate duty it comes into operation on 1 March 2016, but it takes all, no, I beg your pardon, 1 January 2016, but it takes all contributions from 1 March 2015 into account. So it does have a retrospective application of, call it 9 months. All right, then what is the effect of divorce? So divorce orders prior to the 13th of September 2009, where the deduction was made between 1 November 2008 and 1 March 2008. The member was regarded as the taxpayer. The divorce award was taxed at the member's average rate and was tax on tax was payable, where the deduction was made after 1 March 2009. No tax is payable. Divorce orders after 13 September 2007, where the deduction is made prior to 1 March 2009, the member is the taxpayer, and the divorce award is taxed at the member's average rate of tax, and it's tax on tax that's payable again, where the deduction was made after 1 March 2009, the non-member spouse is the taxpayer. We must also just remember for all those made before 1 March 2009, there would have been a right of recourse between the member spouse and the non-member spouse. So basically it just says pre 1 March 2009, it was the non-member spouse, or the member spouse, I beg your pardon, who was liable to pay for it. But from 1 March 2009 going forward, it is now the non-member spouse. So the minute the divorce order is taken into consideration and a payment is made, the person to whom the payment is made is going to be liable for tax. As we mentioned 2 or 3 slides ago with the transfers, if I, as the divorced spouse, decide to take an amount of money from my husband's pension fund and I transfer it into an RA, again, paragraph 6 of the second schedule will be applicable and there'll be no tax payable. So even as I, as a non-member spouse, elect to have a tax deductible transfer done, it will be applicable as well. So there'll be no tax transferred. And again, it's government's way of trying to encourage people to preserve their retirement funds in the same form as what they receive it. Then just the process. So the process, a non-member informs the fund of the intention to claim the money. The fund must offer the non-member spouse the choices within 45 days. So do you want to transfer? What type of transfer? Or do you want it in cash? The non-member must instruct the fund within 120 days of how the money must be paid. Now, that's in terms of the choices offered with the funds or the transfers. I beg your pardon, the cash or the transfers. And then the fund must transfer the money as requested within 60 days. And if no choice is made by the non-member spouse, the fund must make a cash payment within 30 days. And again, page 942, you can go and read it there. Or alternatively, in section 37D, I think it is, the entire process is set out in section 37D of the Pension Funds Act. Now we get to section 37C. This is probably one of the most important sections of the Pension Funds Act that you as an advisor work with on a day-to-day basis. I want to encourage you to go and really study section 37C. Go and read through the detail. Especially with section 37A and section 37D, we often find that people don't always understand the nuances because they see the bigger picture. But there are a lot of little details that's important for you to go and study. And I'm going to be a little bit cruel, to be kind here now, and say that I'm going to give you the basic overview here of what section 37 entails. But I really want you to go onto Acts Online. It's www.acts.co.za. There's a search bar, a Google-powered search bar in Acts Online. You type in pension funds, it comes up. It gives you a nice index on the side. The very last one is the one that you click on. It opens up section 37 for you, and you can literally click on section 37A and read the whole section, 37B and read the section. And really go and do yourself a favor. I think if you had to copy and paste all the sections into a Word document, I don't think it will be more than 5, maybe 6 pages. Just go sit down and really highlight it and read it and try to understand the nuances and the in-depth detail of the section 37A, B, C, and D. All right. So section 37A literally goes about the attachment or execution in the form of a judgment of any pension fund benefits and how it may and may not be done, and when do we look at the pension interest and when do we look at the minimum individual reserve, which is also important to know, not so much for our purposes, but from an actuarial point of view. If you are working with one of the funds and you can say to them, but please show me the difference between the member's interest and the individual reserve to make sure that the right amounts are being deducted, then it already puts someone on a footing where, okay, you know what, I'm not going to try and mess around with this person, because clearly he or she understands what the difference is and what the actuarial reasons are behind the different claims. Then in terms of section 37B, we look at what is protected and what is not protected in terms of insolvency. So no, if one of your clients come to you and say, listen, I'm going through financial difficulty, I'm thinking of voluntary sequestration, you can say to him, but remember, your pension funds A, B, C, this is how they are treated, what's included, what's excluded, and who can lay a claim to anything in terms of one of your retirement funds and who cannot. And then we've got section 37C. I think everyone deals with section 37C, sadly, but on a month-to-month or biannual basis at all. And that's what happens when a person passes away. So at this point in time, you, your client, the dependents, the beneficiaries have no say whatsoever to those funds. The only person who can make any determination at death of a member is the Board of Trustees. Now, I know a lot of people say, but this is so unfair, and it's taking away my freedom of testation, and it's taking away my right to my property away. And yes, it is. And in a financially very literate world, yes, that would be the case. But living in a third world country where we often live with people who are financially illiterate or financially just don't always understand the ins and outs. I sat with a case, and I'm not going to mention any names, but sat with a case where the pension fund was just on 30 million rand, which is a relatively big amount of money. And the person had worked at the same institution for, I think it was just on 52 years, minus a couple of months, got the 30 million rand. And when we looked at the documentation, because we had to determine to whom the funds must pay out, he had nominated his girlfriend, who he had when he started at the company 52 years ago. I think he was 18 or 19 when he started at the company. That girlfriend was no longer part of his life. It was also not part of his wife. He had married another wife, had children with a wife. They were happily married until the day he passed away. And now we're sitting with a beneficiary nomination form of someone he knew 52, 53, 55 years ago. And that's exactly why these type of sections are written in. It's to safeguard against that. No one had ever told him to change his beneficiary nomination form. And he was sitting with a new wife, or a wife. I mean, he was married once to the wife, and they had 3 beautiful children. And if we had to go on the beneficiary nomination form only, this stranger who he knew 50 years ago would have been 30 million rand richer, and his wife and his 3 children would not have been entitled to a cent. And that's why these type of sections are written into our law. A person must also remember the trustees cannot make arbitrary decisions. I serve on the board of 2 funds as a trustee or a board member, and it is really a very thorough process that a person goes through to determine exactly who are the dependents. When is someone a de facto dependent, meaning a factual dependent? When is someone a de jure dependent? What do you do with someone who renounces any right, says, you know what, whether I'm dependent or not in your eyes, I don't want or need the money? How do you handle a situation like that? If you have minor children, how do you calculate when does their dependence come to an end, or when does their dependence not come to an end? So it really is not that the Board of Trustees can just haphazardly decide to whom they pay the benefit. There's a very specific process that not just the Act doesn't set the process out in enough detail, but there are pension funds adjudication determinations, or pension fund adjudicated determinations, that we follow to the letter to say these are the things that need to be taken into consideration. And at this point in time, the pension fund adjudicator, he has more claims based on Section 37C than anything else, because people are not taking the right information into consideration. And she has very little sympathy to say to the board, go back and remake this decision. You guys are talking nonsense here. So although it is limiting freedom of testation, though it is taking or minimizing your right to certain property, it is also looking at the bigger picture in, unfortunately, a country where not everyone is financially literate. Okay. And of course, the reason why I've got nominations with the 3x or question marks is to say that nominations and beneficiary nomination documents are not ignored. There's a reason why we still ask the fund members to complete it. Is because at least then we can take some form of his or her wishes into consideration as well. But if the whole family dynamic has changed, and we can see on the beneficiary nomination that the form was signed 10 or 15 or 20 years ago, immediately that form will carry a little bit less weight than a form that was signed maybe a year or a month or 6 months before the person passed away. And then if we look at Section 37D, Section 19.5 comes into play. And now this is what I often find, especially with the students who don't have a legal background. They're like, oh, Section 19.5, okay, and they carry on. If you see something like that, click on the link and go and look, what does Section 19.5 say? Do you have any idea what the content of 19.5 is? Because if I give you a question relating to the content of 19.5, but you only know what 19.5, the reference, you're not going to be able to answer the question because you don't know what is contained in Section 19.5. So make sure to cross-reference in the acts as well. And then any instance where someone was found guilty, but it had to be found guilty of a crime or a situation or a demeanor of theft, dishonesty, fraud, or misconduct. So you can't be found guilty of doing something by accident. Let's say you were doing your boss a favor, cleaning off his desk, and you accidentally dropped his handcrafted globe, snow globe, and the thing shattered, and you sign an agreement to say that, you know, you accidentally did this. That's not theft or dishonesty or fraud or misconduct. That was really just an accident. So you've admitted to the liability of it, but you won't be able to, that won't come from your pension benefits, because it wasn't something that was done, as I say, with dishonesty, misconduct, theft, or fraud. And then, of course, in terms of any Section 7(8) divorce order, or where a pension fund, I beg your pardon, has an agreement to carry on paying towards a medical scheme, that can be deducted from the pension fund funds, or where there's any outstanding amount for tax. So those are basically the amounts that can be deducted from your pension interest as a pension fund member. And then lastly, ladies and gentlemen, you can also go through this. This is really just theory. I'm not going to explain too much theory to you, but this is really just the theory type of things for the pension funds adjudicator. And on page 941, you can go through all the information. But if we just basically look at it, the pension funds adjudicator was established to have a mechanism through which pension fund matters could be heard from a procedurally fair and economical matter. And then members, previous members, beneficiaries, employers, and the management board or interested parties all have the right to approach the pension funds adjudicator. This is only with reference to registered funds. So, example, the government employee pension fund, which doesn't fall under the pension funds registrar, will not be allowed to approach the pension funds adjudicator. So it's only for registered funds. As you may note, you have any matters that relate to the surplus legislation and which are subject to civil litigation. So those are the two areas where the jurisdiction is a little bit limited. But it's a very interesting, when I was at the Pension Lawyers Association, I beg your pardon, at the beginning of the year, she did a very interesting talk about what is deemed to be, as she's a public office, and that any matters of public interest should be allowed to be heard by her, that her jurisdiction is becoming broader and broader. Just keep that in the back of your minds. And then employment and advice related matters are for the CCMA and for the Ombuds. So anything to do with benefits from the fund, the advice and the employment are things that will not have anything to do with her. And that will also include things like investment choices within the fund. And then procedure sets out to hear both sides and give a judgment that is fair to both parties. So as I say, ladies and gentlemen, you can go through the information on page 941 of the study guide. I don't think there's anything that's particularly difficult about the application of the pension funds adjudicator. I wish you all the best with your quiz. I really hope that it goes well, and please remember that this broadcast is now relevant to the quiz of this week as well as the quiz of next week. So if you maybe don't find something that's too relevant in this assignment, firstly, remember your assignments are a bit juggled, and also there are going to be some questions in next assignment that might pop out of the woodworks from what we've discussed today. Have a lovely evening. Bye.